afternoon, ladies and gentlemen. My name's Scott St John and I look after the Credit Suisse franchise in New Zealand. New Zealand has been somewhat of an island of calm and a sea of storm over the last few years, and there are a number of reasons for that. We've had very, very good leadership in New Zealand in the form of our Finance Minister, our Prime Minister, our Governor of the Reserve Bank, and I acknowledge Dr. Alan Bollard, who is here today, who was the Governor of the Reserve Bank of New Zealand up until the end of last year. The New Zealand economy is staging a gradual recovery. We've got a government that is very focused on its balance sheet, but we've also got a government that is investing in the foundation stones of future growth in the form of their business growth agenda. The final leg of that agenda, which was released only 2 or 3 weeks ago, is titled Capital Markets. And the man whose signature is on the inside of that document is our guest today. Please join me in welcoming New Zealand's Deputy Prime Minister and Minister of Finance, Bill English.
Thanks, Scott. Well, thank you for the opportunity to speak to you about a small and specialised market, but a stable and growing market, characteristics not all that common in developed economies around the world. What I want to do today is talk about the strategic outlook for New Zealand and then some of the factors that are pretty important to New Zealand attracting the kind of investment that we need in order to take advantage of the very substantial opportunities that we have. There's no doubt that the global financial crisis has sped up changes which are going to work to the benefit of the New Zealand and of course the Australian economy. The process of shifting the weight of money and wealth generation from our traditional markets in Europe, UK and the US to the Asia-Pacific region has sped up by, who knows, 15 to 20 years as a result of the global financial crisis. So we see our future determined really by two dominant forces. One is the Asian consumption cycle. As the Asia-Pacific region rebalances to more consumer-orientated economies, they are producing large numbers of middle-income consumers who want to buy more of our products, in particular food products. And probably the food price cycle, as determined by that Asian demand, will be the dominant influence on the New Zealand economy over the next 20 years. The second strong influence is the Australian economy. We are fortunate to be next to the fastest growing developed economy. They are also, of course, locked into the growth in the Asia-Pacific region, but in their case through the hard commodity cycle, which in our view is likely to be a bit more volatile than the soft commodity cycle. Essentially, the better Australia does, the better we do. It's our largest export market. Our competitiveness with respect to them is pretty critical to the success of any businesses in New Zealand. So those are the two larger influences on our economy over the next 10 or 15 years, and that is why we're so positive about our longer term prospects. Because the size of the opportunity is massive, and our challenges are not so much to create opportunities, but to assemble the capital and the people that will be required to exploit those opportunities. Probably one of the things that symbolise best our positioning with respect to the Asia-Pacific region is the free trade agreement we have with China, now in its 5th year. That's an exemplary free trade agreement. I'm sure that the fact New Zealand is a small market and of no particular threat to any productive capacity in China was a factor in the Chinese leadership at its most senior levels sponsoring this agreement, both the negotiation of it but also the ongoing supervision of the agreement. It has meant that China has rapidly moved to become our second largest export destination. The current leadership of China has endorsed the view that they want to see that the trade between the two countries double again by 2020. So we're seeing rapid growth there, particularly around our dairy products, and what drives that is the perception that New Zealand products are safe. We have some of the more rigorous food safety requirements in the developed world, based on a long history going back to the EU requirements in the mid-70s, and that is standing us in good stead for exporting food, food-related products and services into the Asia-Pacific region. Because we are a small economy with big opportunities, we've decided to focus on those things which we can influence directly and not spend too much time getting anxious about bank resolution issues in Cyprus. We have no capacity to influence those things, nor do we spend too much time trying to influence other factors that are creating, other policies that are creating headwinds for us. For instance, the innovative monetary policy in the UK and the US, which has had the impact of pushing our exchange rate to the highest levels in 20 or 30 years. So we've focused on what we can control. And I'll just take you through some of those broad aspects of the framework we believe we have control over. The first is political stability. We're fortunate to have been able as a government, a centre-right government, to maintain public support right through the period of the financial crisis, the subsequent requirements to balance budgets, and the problems that come with rising unemployment. We were elected in late 2008, just a matter of weeks after the Lehman's crash, and we are polling pretty much the same today as we were back then. And the key to that political stability has been to grapple with all the issues that every economy is grappling with in a moderate and consistent way with continuous change over time. So we've been able to maintain public support for fiscal consolidation, for instance. So political stability is a pretty important part of our recipe, and we like to think that'll go on for some time. The second strategy we focused on is macroeconomic stability. In a world where there is so much debate and unexpected innovation in macroeconomic policy, our comparative advantage is to build on the fact that we didn't have a banking crisis, that our unemployment has not got into double digits, and maintain a stable, transparent and predictable framework for monetary policy and for fiscal policy. We, like other countries with stronger currencies, have had internal debate, fueled somewhat by loose statements made by the International Monetary Fund that somehow small open economies can pick their exchange rate. Actually, we can't, and we're not going to try to. So we are focusing on maintaining an inflation-targeting, transparent, independent monetary policy. We're going through the process of formalising macroprudential measures and how that toolkit may or may not be used, and also formalising bank resolution regimes in the event of financial extremity. And we don't intend to change that monetary policy, the monetary policy framework, or the ambit or independence of the Reserve Bank. Consistent with that approach, we also maintain a very stable fiscal policy. Back in 2010, we implemented a fairly significant tax reform that involved across-the-board tax cuts for companies and personal income tax. Top rate of personal income tax is now 33 cents. The company tax rate is 28 cents. And we pushed up our GST, which is one of the more comprehensive GSTs in the developed world, to 15%. That was a revenue neutral package and broadly accepted by the public as the right kind of measure to rebalance an economy that had been driven by debt-funded consumption. At the same time, we set out a path of fiscal consolidation to achieve surplus by 2014-15. We didn't quite expect a major earthquake that hit Christchurch after that budget in 2011. And that major earthquake has required significant government financing of the recovery. It's a $25 billion US recovery effort, of which we're financing around about half. So our fiscal deficit did get out to 9% of GDP. However, the track we set out to surplus has remained stable, and we're on that track, and we would expect to reach surplus in 2014-15. By that stage, our net government debt will peak at around 29% of GDP. In a small open economy that's got fairly high household-driven external liabilities, we need to ensure that the government liabilities are relatively low, and by international standards, they're lower than most, except for probably Australia. That fiscal consolidation will also have the effect of dropping government expenditure from 35% of GDP 3 years ago to 30% of GDP in 2 years' time. And we believe there is ongoing public support for it, and therefore it's likely to be a more permanent and long-lasting change in the call of government resource on the economy. So we focused on political stability and macroeconomic stability. That has given us the opportunity for a third aspect of the strategy, which is an ongoing reform program focused strongly on competitiveness of our economy. The best thing we can do to deal, for instance, with a high exchange rate, and we believe it is somewhat overvalued, the best thing we can do is to ensure that we have as competitive a domestic environment as possible, because again we have pretty direct control over the quality of our investment environment. So we've rolled out a completely transparent program covering a number of the main influences on investment decisions. So we've published detailed programs around infrastructure, both new projects and the quality, how to improve the quality and management of existing infrastructure, around the government's innovation system, around the supply of skills to the labour market, both through domestic skill generation and migration. We've also focused on upgrading considerably our frameworks around the management of natural resources, because we're probably the most weather-dependent developed economy. Our biggest strategic advantage is water, and we believe the economic value of that in our region can only grow as the more populated economies deal with pollution and environmental problems. The value of water and what it can add is going to be part of the growth in New Zealand wealth. That program is targeted in a very simple way on a very simple idea. We will get growth when another dollar is invested and another person is employed. Again, the political environment for that is very positive. New Zealanders understand better now than they ever have the need to attract investment and the need for that investment to be successful. That is how their young people will get sustainable jobs. And of course, attracting investment includes the need to attract offshore investment. Our savings rates are still relatively low compared to our investment requirements. Offshore investment is a critical part of New Zealand's ability to grow. At times it has been politically controversial, but we seem to have weathered the peak of the sentiment that was concerned about inflows of foreign investment, and we are certainly open for business. Another part of that ongoing reform program is a clean-up and rebalancing of the government balance sheet. We run a very transparent approach to the assets and liabilities of government. We publish regular updated information on the balance sheet, which is about 250 billion of assets, which range from about a quarter of it is financial assets, mainly investments in offshore bonds and equities, through to the very large property portfolio that any governments have underpinning their various social services. The next step in the process of making that balance sheet more effective and efficient is that we are privatising a number of our electricity generation companies. 3 of them that have been owned by the government have been put into a program where we'll be floating up somewhere between 5 to 7 billion New Zealand dollars, 4 to 6 billion US dollars of electricity generators largely functioning on renewable energy. The float is directed obviously and with real political purpose towards New Zealand retail investment. So we would expect New Zealanders will be at the front of the queue as we sell down 49% of these companies. But of course we will also welcome institutional and offshore interest in those floats. Alongside those floats, the government is moving, as many have before, to greater use of public-private partnerships. We have the benefit of being close to one of the more mature PPP markets in Australia, and we've learned a lot of lessons from watching what they've done well and what they've done badly. We're the sort of market where it's hard to generate a pipeline of similar type PPPs. The New Zealand market will always have smaller, more customised PPPs, which mean that where we've completed them, we've been able to secure pretty innovative contractual arrangements around risk. The reason we do it is not to execute off-balance sheet financing, because we run a fully transparent accounting system where it all has to be accounted for in our accounts anyway. The reason we do it is simply because we're looking for people who can manage the operational and financial risk of these large assets better than public servants. And generally, there's a lot of people who can run them better than a public service. The effect of our positive view about the opportunities in Asia and the kind of reform program that we've been able to pursue and will continue to pursue is that we have reasonable prospects for growth. The current forecasts by the OECD, the IMF and the New Zealand Treasury indicate for the next 3 years growth of, on a good day, 2.5% to 3.5%, which would be a bit above trend, and on a day when they're not quite so sure, 2 to 3% growth. I suppose the point about this growth is that it's underpinned by a sound policy environment rather than government fiddling around with stimulus or trying to fudge the fiscal track, and certainly asset prices in New Zealand are not the subject or not the result of quantitative easing. So we would expect that 2 to 3% growth is, while moderate, is fairly secure as we look ahead, even with the broad uncertainties that you deal with every day in the market. Probably the reason that gives us the most confidence about the future for New Zealand is the resilience that New Zealand has shown through the recent global financial crisis. New Zealand has been an open economy only for about 25 years. And early recessions had a very large impact on our productive capacity and on national morale. But after 25 years of dealing with our own very significant restructuring in the late 80s and early 90s, the Asian crisis in the late 90s, our businesses have a greater level of confidence and competence in dealing with the pressures that a small open economy deals with. A good measure of this is the ongoing growth of our manufacturing sector. As you can imagine, being a manufacturer in New Zealand is quite a challenge. We are further away from any populous market than anyone else in the world, pretty much. The domestic market is quite small, so therefore quite small companies have to be able to export at a very early stage in their life cycle. Despite these handicaps, and despite the fact that we've had the highest dollar in a generation against the US, our manufacturing sector has continued to grow at moderate rates, but nevertheless it has grown. The reason that has happened is because our companies have been forced to develop specialised and deep expertise, often in quite unpredictable niches. If they don't do that, they simply don't survive. Part of that trend has been the separation of production from design and innovation, and probably the most recent higher profile example of that was the purchase of Fisher & Paykel whiteware by hire. It makes a lot of sense for production capacity that was in New Zealand to go to lower cost locations, but the innovation and the design has all stayed in New Zealand, and in fact, because of higher scale, they have been able to invest considerably more in that capacity than the local owners would have been able to. And we see that as a likely pattern that will develop further as there's a growing understanding of the connection between New Zealand and the Asia-Pacific region. So we expect to build on those strengths, the political stability, the macroeconomic stability, an ongoing process of reform, free trade agreements which connect us to most of the Asia-Pacific region, more so than pretty much any other country, and a fundamental resilience in the New Zealand economy. These factors, we believe, make us a specialised but attractive investment destination. Thank you.
Okay, so we've got some time for questions. Are there some questions from the floor?
Yep, I have two questions, if I may. The first is, we're hearing from a number of Asian governments about trying to develop the Trans-Pacific Partnership. And I was just wondering what your views are, given that New Zealand was one of the prime motivators behind this. And the second one is, in the case of New Zealand, we're hearing reports of a potential drought. I'm just wondering how much of a knock that could have on the economy.
Okay, well, I'll deal with the second one first. Fortunately, on the weekend it started raining, and that helps.
And it still is, I believe.
And it's still raining. Okay, I hope it's still raining when I get back. I think the thing to remember here is drought in New Zealand is something different than the common usage of the term in Australia and the US, where we generally hear about it. They can have droughts that go on for several years. In New Zealand, a drought is when it doesn't rain for 6 weeks. We are a very rain-dependent economy. So the impact of it is felt directly, mainly through the primary production sector, in particular the dairy sector. So it will have the effect of knocking, who knows, sort of 0.5 to 1% of GDP off our growth rate over the next 12 months. If it had continued for another month or 6 weeks, then it could have been another percentage point. There's some offsetting factors. Because New Zealand dominates, or such a big factor in world dairy trade, the fact that we've had a drought means supply is constrained and the milk powder price has gone up. I think 10% in the last 2 weeks ago in the last auction.
20% last night.
20% last night. Well, there you go. Someone's taking the drought seriously in New Zealand. So that means they're going to get paid out more for the production they do have. So we're not overly concerned about it. It will peg things back a bit. Look, there'll be other pluses on the other side of the ledger. What's critical here is that the agribusiness sector in New Zealand is very resilient. It's run unsubsidised for 25 years. They know that they have to deal with those risks, and they're actually getting pretty good at it. So they'll get through. Oh, the second question was about the TPP. Yeah, look, the TPP has become a bit bigger, I think, than we originally envisaged. As one of the original promoters, the key target in it was the US, the US, and secondly, getting a high-quality free trade agreement. And by high quality, we mean including all the things that no one else wants to include, and that is particular agriculture. And what has happened is that, as I think you're aware, a broader group of countries have decided they're interested in it, and we've got to negotiate our way through a very complex process with multiple participants without trading off quality for breadth. And that is going to take some time. So if you take Japan has put its hand up again, Canada indicated an interest. Both of these have strong agricultural lobbies who might not have put their name on the press release about the enthusiasm for the TPP. So we are backing ourselves and others who are keen to see it happen to continue with the negotiations, but we don't want to change the quality of it because some harder cases have decided to show up. This is another example of a small economy playing to its strengths. We have particularly good global capacity for negotiating free trade agreements. In fact, one of our guys is running for Secretary of the WTO. We had a guy there a few years ago because there's strong bipartisan support in New Zealand, and we are going to continue to broaden our free trade agreements. I think we're headed towards FTAs with about 60% of the global population. Now that's more than enough room for a small economy with potentially unlimited opportunity.
Other questions?
Mr. English, thank you. We heard at lunch about people living longer from BlackRock and the need for more retirement savings. I'm surprised that New Zealand hasn't done more and perhaps followed the Australian lead in terms of compulsory superannuation and a much larger share of retirement savings. Could you comment, please?
Yeah, look, I think the New Zealand retirement savings system is going to get more like the Australian one, but I hope it doesn't end up the same. I think there's going to be growing questions about the Australian super, and I know the industry itself is starting to ask those questions. There's no free lunch here. I mean, in the end, your retirees have a standard of living that reflects your productive capacity on the day, and all a super scheme is a way of dividing claims on the capacity that exists at the time you are 75. So we've got an unusual set of arrangements. We've got quite a high level of universal pension, and that is the product of 30 years of intense debate in New Zealand, and that's where it's settled on a universal pension, which for a married couple is 65% of the after-tax average wage. And now we've got KiwiSaver, which was instituted by the previous government and has turned out to be probably more successful than anyone expected. It's an auto-enrolment system, so every time someone applies for a job, they're automatically enrolled and they have to opt out. And something like 60% of the adult population is in it within 5 years and staying in it. So that will continue to grow and will, I think, be modified over time to become more like Australian super. So we want to learn the benefits of their system. I think they're trying to push the contribution levels up another notch with 3, and I'm not quite sure what the rationale for that is. I wouldn't expect the New Zealand scheme will get to 12 or 13% contribution rates.
I'll just add our contribution ratio is going up on April 1 to about 6% in total. Question over here.
Just on the Canterbury earthquake, how do you assess, on the Canterbury earthquake, how do you assess the rebuilding effort and how far do you think we are down into this effort?
How far?
Into the rebuilding effort are we now?
Oh, okay. Look, with Christchurch, the first earthquake was in early 2011, but there was on the day before Christmas Eve in 2011 a 6.3 earthquake in Christchurch, which would have devastated the city if it wasn't already devastated. So there's nothing left to knock down. So to be fair to the insurance companies, and New Zealanders aren't because they're mainly Australian insurance companies, to be fair to the insurance companies, they did have to wait for it to stop shaking before they started rebuilding. And it's actually only 15 months since the last major earthquake. So we're reasonably pleased with progress. How far into it are we? I think on that, if you think of the whole thing as about 25 billion US, we wouldn't be 5 billion into it yet. The funding is all there. It's just a matter of getting the planning done. For instance, we've got to re-road and re-pipe most of the city. Got to build 10,000 residential houses and rebuild a CBD where 1,000 buildings have been demolished. In fact, 1,200 buildings have been demolished. So the central business district is just a large sandpit right now, which spells massive opportunity. So what the government's doing is we've got to share the costs that aren't where the insurance isn't covered. But we're in the CBD, in order to encourage investment, we have specified a series of public infrastructure, convention centre, brand new hospital, and half a dozen others, so that investors can see the government's committed and we'll be building. And we hope to be building within 6 months there. The other major factor in all this is it's the most insured natural disaster that's occurred anywhere. And we discovered, for those of us who are naive, insurance companies don't like total coverage. So they get a disaster in New York and it's 30% covered. You have one in New Zealand, it's 98% covered. So the reinsurers have been doing a very thorough job of looking after their interests. Or just because they're worried about government being in there bending the rules at their cost. But we've developed a very positive, open relationship with them, and of course with their main customers, the insurance companies. So that's moving along reasonably well. But as you know, insurance is complex. When you've got multiple insurers, particularly in multiply owned properties, and you've had 15 earthquakes of a size large enough to trigger reinsurance. Okay, 15 earthquakes, not one event, but 15 events. And that creates opportunity for plenty of hassle. But it's getting solved, and the level of activity is picking up quite quickly now. Our main worries, I think, ahead are quite predictable: price inflation and shortage of labour. We're getting the benefit of all those young Irishmen who lost their jobs in the construction industry in Ireland, and they're all turning up in Christchurch. And some of them aren't bad rugby players, which helps.
Other questions? Sorry.
There's been a fair bit of talk at this conference about labour unit costs, and particularly the progress being made in Europe at the moment. Whereas across the Tasman, Australia's going in the opposite direction and costs are rising very rapidly. Could you give us a burst on New Zealand and labour costs?
Yeah, look, we have, this is a bit of a discussion in New Zealand because of the wage differential between New Zealand and Australia. It's effectively one labour market. Young New Zealanders see their choices as Christchurch, Auckland, Sydney, Perth. Okay, and it costs them the same to get to any of those places, and there's just as many Kiwis wherever you go. So our comparative advantage is the flexibility of our labour market. So our businesses aren't subject to some of the same pressures that Australian businesses are, and we're starting to notice increasing attention, particularly from the Australian owners of capital in New Zealand, who, faced with capital allocation choices, are starting to think, actually, we should put this capacity in New Zealand because the energy market works better, the infrastructure's better, the labour market's more flexible, and actually they do just as good a job. And we intend to keep cultivating that relative advantage. And in Australia, as you know, it's fed by the investment boom in mining, and they've got a few challenges there. And I think it's starting, but I think they'll resolve them because they're seeing, as the projects get cancelled, they'll start correcting for that. So we don't think that, I'm quite sure Australia within a few years will have sort of reset at a more competitive level.
There's a question at the back.
Just wondering what the rationale is for maintaining 51% ownership in these vehicles.
Yep. It's a political decision. New Zealand went through a phase. We had quite large-scale privatisation in the early 90s, or late 80s and early 90s. Some of those privatisations turned out to be fairly unpopular. Not so much because of the sales themselves, but the perception that they didn't work. So the government ended up buying back Air New Zealand, but that was really because of company failure. It wasn't privatisation per se. And buying back Kiwi Rail, which was the rail company, was operated by Toll, and there was just various issues that became unresolvable. So the government of the day bought it back, and unfortunately they paid something for it, which wasn't a very good idea because it wasn't worth much. So it's had a big political background. We took a significant risk as a government in the start of 2011, which was election year, saying that we would restart asset sales. And we spent all election year campaigning on it and arguing over it to ensure that if we were re-elected, the mandate was absolutely clear for a policy that was regarded as a suicide policy when we started. We got re-elected. You can argue about whether it's because we won that argument or because we were a first-term government and we deserved another go. Nevertheless, the constraints we put on it were majority government ownership, New Zealanders at the front of the queue. So from our point of view, it's, from an economic point of view, it's not the optimal outcome. From our point of view, it will be a significant step forward in our ability to free up cash from our own balance sheet, improve the performance of the companies, boost our public market, and achieve widespread share ownership among New Zealanders. Even though the public thought they didn't like it, we've had a pre-registration process opened for 3 weeks, and over 10% of the adult population have pre-registered. In fact, it's climbing close to 15% of the adult population. So we're getting a bit of interest in it.
Just following on the mixed ownership model, you talked about the pre-registration. How is the mood amongst New Zealanders more broadly with respect to that, and what do you see as the timing for that program to roll through?
I think the mood is pretty pragmatic. So they've had enough of the political argument, which went on for 2 years, including a court case through to the Supreme Court, which we won. And now they're ready to make an investment decision. Made a political decision, didn't like it, or did like it. Now I'm going to do what I think is best for my growing savings, because more of them are saving. Of course, the test is how many actually write out a cheque. But 400,000 is not a bad pool. 400,000 people is not a bad pool to be fishing in. With respect to timing, this one will, run through to a float in early to mid-May, and we'll shortly be making decisions about the next 2 floats, which might be this year or there'll almost certainly be one this year, but they might flow over into next year. So there's 3 in a row, and they're roughly, and our estimate for proceeds is somewhere around 5 to 7 billion.
Why do you say the New Zealand dollar is overvalued?
Why? Oh, but just because it's higher than what suits us. I mean, in a sense, it is the value is what the market says it is. And I'll tell you why many New Zealanders think that way. On the one hand, the credit rating agencies keep telling us that running 30 years of current account deficits is pretty bad, and we've got a fairly significant net international liabilities position, around 70% of GDP. Now that's higher than we would like, particularly when international markets are so volatile. So we've had that story on the one hand that says you're a small economy with big external exposures, and that's risky. On the other hand, the market doesn't seem to believe that, and they keep telling us through our currency that we're a better bet than a lot of places. Now, that's most people have been brought up with the first story and are a bit surprised about the second one. I think the qualification on the first story, this is where I disagree a bit with some of the policy makers, is a fair bit of those external liabilities are intermediated through the Australian banking system. We've got one banking system. In other economies, they wouldn't be regarded as external liabilities. But that's a bit of a quibble at the margin. In the long run, we need to sell more stuff for higher value and save more of the proceeds so we can reduce our external liabilities.
You mentioned earlier about making better use of the water resources. Is there any concrete plans for that, and does that run into environmental and Maori issues?
Well, it's because of the environmental and Maori issues that we're coming up with a new framework. So there are concrete plans which the government is putting a bit of seed money into for greater use of irrigation, more widespread irrigation, and we're trying to cast that in a commercial framework because I think there's opportunities there for investors and we need to move past the traditional model of the farmers capitalising it all, because farmers are very miserly with capital and they want it, you know, cheap or subsidised or whatever. So that's concrete. What we're trying to do is create a framework where we can build public confidence that we can have intensive agriculture and clean water. And at the moment, in the past, it's been regarded as too thorny an issue to deal with. People have seen them as direct trade-offs, and there's been a lot of politics around it in a country with 100% pure as its slogan. So we've got to back that, particularly in the context of Asia-Pacific markets, where to the extent we have cachet, it's about that image, particularly related to our food and tourism products. So we've got to give it substance. And we're in the process right now, getting near the end of a 5-year process to create a framework which will have agribusiness essentially measuring its polluting capacity in a detailed way and regulating that without knocking too much off our economic growth potential. So it'll be, I think, fairly unique actually by the time we get it legislated towards the end of this year, and a big opportunity for people who've got the technology to be able to monitor particular water flows and the pollutants in them, because we're going to measure diffuse discharges right across our production system. So it's a big step, but it's a process that's come out of a high degree of collaboration between the environmental groups, the recreational users and the farmers. And we can, pick the best out of scarcity systems in Australia and California, for instance, and apply it in our, adapt it to our environment.
So there'll be some sort of tax on the farmers that's
We've already got a number of examples. We've got the world's first nitrate trading system, cap and trade system, operating now around Lake Taupo, which is a very large lake. And so I think you're less likely to see tax processes and more likely to see something analogous to an emissions trading system in the long run. We're a wee way from that yet. The first steps are to establish a baseline data and management systems, expand the application of management systems that are currently understood. I mean, the economic benefit of it is, for the producers, is that when they focus very strongly on, say, their fertiliser use, the tools available now through precision farming mean that you can actually save a lot of input cost and get as good a result. And that's why they're interested.
Well, ladies and gentlemen, I think we're going to wrap it up there. Thank you all for attending, and Bill, to you and your team, thank you so much for making the journey up here. If you could join me in thanking the Minister for his presentation, please.